If you think the stock market is just about buying a stock and waiting for it to go up, you're already at a disadvantage. Because the market was never designed to be easy. It was designed to work. And when you don't understand how it really works, you end up playing a game where other people know the rules. And you don't. Every year, millions of people start investing in the stock market believing they will make money fast. And every year, many of them lose money. Not because the market is fake, not because investing doesn't work, but because the system is more complex than it looks. Today, we're going to break down how the stock market really works, why so many people lose money, and how you can avoid the mistakes that trap most investors. We're going to explain everything step by step, block by block, and once you see the structure clearly, the market stops looking random and starts making sense. The stock market exists for one main reason. Companies need money to grow. Investors want to profit from that growth. So the market connects both sides. When a company needs capital, it can sell small pieces of ownership. These pieces are called shares. When you buy a share, you become a partial owner of that company. If the company grows, the value of that ownership can increase. If the company performs poorly, the value can decrease. That sounds simple. But the price of a stock is not based only on what the company is doing today. It's based on expectations. And expectations are driven by psychology, money, supply, interest rates, and investor behavior. That's where most people get confused. They think the stock market moves only because companies make money. In reality, the market moves because people believe companies will make money in the future, and belief changes fast. Let's imagine the market using blocks. Each block represents value. A company builds value slowly, revenue grows, profit grows, the business expands. Normally, the stock price should grow at a similar pace. But sometimes, investors become too optimistic. They start stacking blocks faster than the company can actually grow. Prices rise faster than reality. This is how bubbles start. And bubbles are one of the main reasons people lose money in the stock market. Not because investing is bad, but because people buy when prices are already too high. Another thing most beginners don't understand is that the stock market is not just about companies. It's also about money flowing through the system. When interest rates are low, borrowing is cheap. When borrowing is cheap, investors take more risks. More money goes into stocks. More demand pushes prices higher. When interest rates rise, the opposite happens. Borrowing becomes expensive. Investors become cautious. Money leaves the market. Prices fall. This is why the stock market often drops when interest rates go up. Not because companies suddenly became bad, but because money became more expensive. Understanding this alone already puts you ahead of most investors. Now, let's talk about the biggest mistake people make. They think rising prices means safety. When a stock keeps going up, it feels like the right decision to buy. Everyone is talking about it. News is positive. Social media is full of success stories. And that's exactly when risk is highest. Because when prices rise too fast, expectations become unrealistic. And unrealistic expectations eventually break. The market doesn't need bad news to fall. It only needs reality to be less perfect than people expected. That's enough to trigger selling. And once selling starts, fear spreads faster than optimism. Another reason people lose money is leverage. Leverage means investing with borrowed money, margin accounts, loans. Credit used to buy stocks. Leverage makes gains bigger, but it also makes losses bigger. If the market drops 20%, a leveraged position can lose much more. Sometimes everything. And when losses grow too fast, investors are forced to sell. Forced selling pushes prices down even more. This is why crashes happen so fast. Not because everyone wants to sell, but because many people have no choice. Now, let's talk about timing. Many people believe they will sell before the crash. They say, "I'll get out when things look risky." But bubbles don't look risky at the top. they look strong. Confidence is high. Profits look easy. Experts sound optimistic, and the turning point is usually small at first. A few bad earnings reports, a small change in interest rates, a slowdown in growth, nothing dramatic, but enough to change expectations. And once expectations change, prices follow. That's why trying to perfectly time the market rarely works. Structure matters more than timing. So how do you avoid losing money? First, understand valuation. If prices rise much faster than profits, risk is increasing. Second, avoid concentration. If one stock becomes most of your portfolio, your risk grows automatically. Third, control leverage. Borrowed money increases fragility. Fourth, keep liquidity. Cash gives you flexibility when markets fall. And flexibility is power. When others panic, those with liquidity can act. Those fully invested can only watch. Diversification also matters more than people think. Different assets react differently to economic changes. Stocks, bonds, real estate, cash, commodities. When everything is in one place, one mistake can hurt a lot. When your portfolio has balance, shocks become easier to survive. The goal is not to avoid every loss. The goal is to avoid catastrophic loss. Because big loss is slow, long-term growth. And investing is a long-term game. Here's the truth. Most people learn too late. The stock market is not designed to reward excitement. It rewards discipline. It rewards patience. It rewards structure. People lose money when they chase fast gains. They lose money when they follow hype. They lose money when they ignore risk. But those who understand how the system works stop reacting emotionally. They start thinking in probabilities. They start thinking in cycles. They start thinking in structure. And once you understand the structure, the market stops looking like gambling and starts looking like a system you can survive, a system you can use, a system you can build with. There's another part of the stock market that many people never think about. Who are you actually competing against? When you buy a stock, you're not buying from the market. You're buying from another investor, and that investor might be a professional. Large institutions, hedge funds, banks, algorithmic trading systems. These participants have more information, more tools, and more experience. They don't invest emotionally. They invest strategically. That doesn't mean you can't win, but it means the game is not equal. If you enter the market without understanding the rules, you're not investing, you're guessing. And guessing works until it doesn't. Another thing most people misunderstand is volatility. When prices move up quickly, people feel excited. When prices move down quickly, people feel scared. But volatility is not the enemy. Uncontrolled risk is the market naturally moves in cycles. Expansion, optimism, euphoria, correction, fear, recovery. These cycles repeat over and over again. People who don't understand cycles think something is broken every time the market falls. People who understand cycles know that movement is normal. And when movement is normal, panic becomes optional. Let's go back to the blocks again. Imagine the market as a tower built from value blocks. Each block represents real growth, revenue, profit, innovation, productivity. When the tower grows at a stable pace, the structure is strong. But when investors start stacking blocks faster than the base can support, the tower becomes unstable. The higher it grows without support, the easier it falls. This is what happens in bubbles, and bubbles are where most people lose money. Not because they entered the market, but because they entered at the wrong time. There is also something called market sentiment. Sentiment means how investors feel, not what the numbers say how. They feel when sentiment is positive. People take risks. They buy more. They ignore warnings. They believe the market will keep going up. When sentiment turns negative, the opposite happens. People sell fast. They become cautious. They look for safety. The same asset can look safe one day and dangerous the next. Nothing changed in the company. Only expectations changed. This is why emotions move markets more than facts in the short term. Now let's talk about long-term investing. Many people enter the market expecting quick profit. But the stock market was never designed for short-term certainty. It rewards those who stay consistent over time, not those who try to predict every movement. If you invest with a long-term structure, temporary drops become less dangerous. If you invest emotionally, every drop feels like a disaster. The difference is not the market. The difference is the strategy. Another mistake beginners make is thinking that more trades means more profit. In reality, the more you react to every movement, the more mistakes you make. Professional investors often do less, not more. They choose carefully. They manage risk. They accept that they cannot control the market. They only control their position inside it. This mindset changes everything, because once you stop trying to win every move, you start protecting your capital. And capital protection is what allows growth over time. Here's something very important. Losing money in the market doesn't come from one bad trade. It comes from a series of emotional decisions. Buying because everyone is buying. Selling because everyone is selling. Holding because you hope. Doubling because you want to recover faster. These decisions feel natural, but they destroy consistency. And consistency is what builds wealth, not luck, not hype, not one good trade. Structure. The stock market is not a place where everyone wins. It's a system where discipline wins. People who understand risk survive longer. People who survive longer have more chances to grow. People who chase excitement burn out faster. So, the real goal is not to beat the market every day. The real goal is to stay in the game long enough for compounding to work. Because time is the strongest force in investing. And time only helps those who don't lose everything first. Once you understand how the stock market really works, you stop asking how to get rich fast. You start asking how to avoid losing. And that change alone puts you ahead of most investors. Because the market rewards those who respect risk, not those who ignore it. And when you see the structure clearly, you realize the market is not random. It's a system built on expectations, money, flow, psychology, and discipline. And once you understand the blocks, you can build instead of guessing. Block by block.